everyone. So today we are going to discuss about the fraud story of Enron, Worldcom, and Satyam. Let us introduce ourselves. Here is Farhan Abid, Fauzan Dimas, Triwidya Stuti, and Natasha Kristianti. The first thing we are going to discuss is the case of Enron, which was once the 7th largest corporation in America. What happened to Enron? Houston Natural Gas merged with Internorc to form Enron, a natural gas pipeline company. In 1989, Enron began trading natural gas with Kenneth Lay as the CEO. In 1990, Jeffrey Skilling joined Enron and became Enron's president and chief operating officer 6 years after. Skilling introduced mark-to-market accounting that allows company to write profits on their books on the day the deal was signed, that allows company to reap billions of dollars. As this approach applied, Enron grows in trading market very fast that it was listed in Fortune 500 most innovative companies list. But this led into something bigger. A Fortune reporter, Bethany McLean, questioned on how exactly Enron makes money. Skilling could not answer to the question as he was the CEO in the time and decided to resign in 2001 and Lay took over as the CEO again. Skilling sensed the trouble happening in the company. A day after Skilling resigned, Sharon Watkins, a finance executive working under the CFO Andrew Festo, sent a letter to Kenneth Lay about her findings on fraud in the company. Arthur Andersen instructs workers who audit Enron's book to destroy all but the most basic documents, and Enron reports a third-quarter loss of $618 million. SEC launched an inquiry on Enron, and Enron admitted overstated profit by $600 million. SEC expanded the investigation to cover Arthur Andersen, and finally Enron files for bankruptcy in 2001. Enron lays off 4,000 employees. Kenneth Lay resigned as chairman and chief executive of Enron. Arthur Andersen surrenders license to practice in U.S. 85,000 lose their jobs. Andrew Festo indicated on 78 charges on conspiracy, money laundering, and other counts.
Now it's time for Worldcom. It was at one point the second largest telecommunication company in the United States, led by the CEO Bernie Ebbers and CFO Scott Sullivan, and is perhaps best known for a massive accounting scandal and regarded as one of the worst corporate crimes in the history. The scandal came to light in 2002 after the Internal Audit Department led by Cynthia Cooper uncovered $3.8 billion in fraud. Worldcom inflated assets by as much as $11 billion, leading to 30,000 people losing their jobs and creating $180 billion in losses for their investors and much more. So how did this happen? The $3.8 billion of line cost, which is an expense, was capitalized as an asset in the prepaid capacity account. The increase in assets and decrease in expenses led to a greater earnings revenue ratio and net income, and altered the total amount of asset on the balance sheet. This was of course made the company appear better than it actually was. What might be the reasons? Now let's look at the fraud triangle: pressure, opportunity, and rationalization. First, Ebbers and Sullivan put pressure on the company to meet certain financial marks. And when those marks were unattainable, they began to make fraudulent adjustments. This pressure also led to employees making fraudulent choices based on their own personal reputation in the company and their own incentives. Second, these were mostly due to their lack of internal control system that created the inability to keep track of records, and the fraud slipped through the non-existent radar. They failed to create a positive working environment, and when the push came to shove, the employees gave in to the ridiculous demands of the top management. Third, they rationalized their fraud by believing they would only need to make a few entries to make the company appear successful. They believed that they would only need to make accrual releases to fix their issues. However, they ran out of accrual releases and they had to turn towards changing expense capitalization. That started out as a few minor injuries into a $3.8 billion inflation of the company. As for the penalties, Ebbers was sentenced to 25 years of fraud, conspiracy, and filing false documents with regulators. Sullivan received a 5-year jail sentence after pleading guilty and testifying against Ebers, and David, the former director of general accounting, was sentenced to 1 year in prison.
Hello, my name is Fauzan Dimas, and now we will discuss about the Satyam scandal. Satyam is an IT company that services offering software development, system maintenance, and packaged software integration. However, the company is very controversial with tax evasion and accounting scandal, which is very fraudulent. The frauds are mostly done by Ramalinga Raju, the CEO of the company. He suddenly confesses that he manipulated 40,162 crore and convicted of corporate fraud, which leads to the collapse of Satyam Computers. And it is found the former chairman and CEO of Satyam Computer Services. Before everything, the CEO invites the stockholders and said that the company had achieved this in a challenging global macroeconomic environment, and it is very proud for that. But instead, he forged and cooked the book of his company, and then he's being charged of breach of trust conspiracy, cheating, and falsification of records after he confesses that he'd done those things. The reason of his confession is, however, not specified and not being declared by the CBI. The court procedure started at November 2010 when Raju surrendered after the Supreme Court, and then the Enforcement Directorate filed a charge sheet against Raju and 212 other employees in October 2013. One of those employees is his own brother, which both will be discussed later on. On May 2015, Raju and his brother is found guilty, and by January 2018, PW is banned from India for 2 years because of this controversial act. PW is Pricewaterhouse, the Indian division of PricewaterhouseCoopers, and it announced that its reliance on potentially false information provided by the management of Satyam may have rendered its audit reports inaccurate and unreliable. Everyone was shocked by the contents of the letter given by the senior leaders of Satyam. Immediately after this news, Merrill Lynch, which is part of Bank of America and State Farm Insurance, terminated its engagements with the company, and also several other companies around USA and all other countries. Satyam's share fell to 11.50 rupees on 10 January 2009, their lowest level since March 1998. All in all, we can conclude that what the company did here is very destructive for the company itself.